Welcome to Min Chao, where law, finance, and real estate complexities are made clear, actionable, and empowering. The information provided on this channel is for entertainment and educational purposes only and does not constitute legal, financial, or real estate advice. For advice tailored to your specific situation, please consult with a qualified professional. If you'd like to consult with us, please book an appointment through our website. Investing involves risk, and you could lose some or all of your investment. Past performance is not indicative of future results, so whether you're looking to protect your assets, grow your wealth, or make intelligent real estate moves, you've come to the right place. Chapter 2, Top 10 Essential Option Terms. Every investor needs to know you're out there living your best life, perhaps sipping oat milk lattes and binge-watching an exciting movie, but back home, Theta's raiding your portfolio like a raccoon in your kitchen at 2 a.m. Yes, even if your stock is sitting still like a Zen monk on vacation, your option is melting like ice cream on a summer sidewalk. Welcome to the magical world of possibilities, where time doesn't just fly, it steals your lunch money while making eye contact. In this chapter, we will explore the top 10 essential option terms every investor needs to know, without the hedge fund jargon, existential dread, or the need for a PhD in Greek mythology. Let's decode the chaos, one term at a time. Strike price. Let's start with the strike price, which you can think of as the price printed on a pizza coupon. If the local pizza place raises prices from $10 to $15, but you have a coupon that still states $10, congratulations. You've just locked in a tasty profit. That's essentially what a strike price does in options trading. It establishes the price at which you can buy or sell the stock, no matter how the market price changes. Choosing the right strike price is like selecting the right weapon in a video game. It won't guarantee victory, but it sets you up for success. Expiration. Next is expiration, the use it or lose it date marked on your coupon. Options have expiration dates, just like milk. However, unlike expired dairy with a foul odor, expired options can teach valuable lessons. If you are holding on to a call option like a vintage Beanie Baby, remember that value fades quickly, just like motivation after midterms. Embrace the journey and make timely decisions for a brighter future. This is when your option either turns into a sweet profit or becomes expired potential. Picture the disappointment of finding your pizza coupon 2 days after it has expired. In options, timing is everything, whether you're betting that the stock will rise or fall. If you miss your window, the opportunity vanishes faster than an unattended ice cream cone in July. Successful traders don't bet on price. They also wager on time. Premium. Then there's the premium, the price you pay for the opportunity to pursue your dreams. When you buy an option, you aren't purchasing the stock itself. You're buying the right to buy or sell it later at your chosen strike price. This right comes at a cost known as the premium. Paying a premium for an option is similar to entering an exclusive party. Will it be the night of your life if the stock moves in your favor? Or will the DJ be terrible and the drinks overpriced, resulting in the option expiring worthless? Regardless, you've already paid at the door and no refunds exist. Sometimes you hit it big. Other times, you gain experience while losing money. Regardless, that premium is the cost of possibility. If buying options is the pursuit of dreamers, like paying $5 for the chance to turn an idea into profit, then selling options is the strategy of realists. Option sellers are the ones collecting those premiums. When you sell a call option, you're hoping the stock won't rise much, because if it does, you may have to sell your shares at a discount. When you sell a put option, you hope the stock doesn't drop significantly. Otherwise, you might buy it at a higher price. It's akin to betting with a friend that their favorite TikTok star won't go viral. If you're correct, you pocket the reward. If you're wrong, you might find yourself explaining why you owe someone a hoodie pizza. In summary, buying options involves risking a small amount, the premium, for a potentially significant reward, ideal for optimistic thinkers and calculated risk takers. On the other hand, selling options means collecting money upfront while hoping for minimal drama, perfect for cool-headed strategists who can handle chaos if things go awry. Both approaches have their risks and rewards. It's like choosing between playing the game and running the lottery booth. In the money, ITM, the rockstar of your portfolio, when your option is in the money, ITM, you're already on the path to profit. It's like slipping into your favorite jeans and discovering a crisp $20 bill in your pocket. Unexpected money you genuinely deserve. This condition arises when the strike price is better than the existing market price. For call options, the stock price exceeds the strike price, while for put options, it is below the strike price. You've made the right call, and the market cheers for you. Your option is a vibrant addition to your portfolio, celebrating success alongside you. At the money, ATM. The option that embraces its potential. At the money, ATM, happens when the stock price perfectly matches the strike price. An ATM resembles an adventurous spirit with a sleek leather jacket and a roaring motorcycle, always eager for new experiences. One small move in either direction and bam, you're cruising or crashing. There's no intrinsic value here, just time value and a sense of anticipation. It's neither a win nor a loss. It's a moment of pause, perfectly poised for the next opportunity. ATM options shine in short-term strategies, allowing you to embrace the excitement of the unexpected. Out of the money, OTM. The optimist on the sidelines. Purchasing an out-of-the-money OTM option is akin to buying a lottery ticket and giving it a name. It has the potential to turn into a success story, or it may simply expire worthless while you sigh, "But I believed in you." It embodies pure optimism, but with a deadline. Out of the money, OTM, represents financial limbo. Your option is technically alive, but ineffective, like a remote control with dead batteries. For call options, the stock price is below the strike price. For put options, it's above. It hasn't moved in your favor yet. Your option may be on the sidelines, watching the game in flip-flops, but it's full of hope for a comeback. If the market shifts in your favor, you could quickly rise from underdog to legend. Review of call and put options, ITM, ATM, and OTM. Understanding whether your option is ITM, ATM, or OTM empowers you to evaluate its intrinsic value, risk profile, and time sensitivity. It reveals whether you're riding the gravy train, parked at the station, or jogging alongside the tracks, ready for the next adventure. Buying a call option, betting on the climb. You buy a call option when you anticipate that the stock price will rise. This strategic agreement grants you the right but not the obligation, to purchase a stock at an agreed upon price, referred to as the strike price, before a designated date. In our chart, the strike price is $100, represented by the orange line. Furthermore, you have paid a premium of $5 for the option, resulting in a total investment of $5. Now, here's where things get spicy. If the stock is lower than $100, your option is out of the money. OTM. Your option expires worthless and your $5 vanishes into the trading abyss. If the stock lands exactly at $100, you're at the money. ATM. You've matched the strike price, but still lost the premium you paid. This is no gain, but it is not the worst loss. If the stock exceeds $105, you're in the money. ITM, dancing in the green zone. Every dollar above $105 is profit beyond your break-even. Now you're cheering, let's go. Buying a put option, rooting for rain. A put option is the moody sibling of the call. You buy it because you think the stock will fall. Again, the strike price is $100 and you've paid a $5 premium. If the stock closes above $100, the put is out of the money. No one wants to sell at $100 if they can get more elsewhere, so you lose the premium. At $100, your ATM. Nothing gained, still down $5. If the stock plummets to $80, your ITM. You sell at $100, pocketing $20 minus your $5 premium, netting a sweet $15 gain. Selling a call option, getting paid to wait. When you sell a call, you say, I'll sell you this stock at $100 if you want it. For that promise, you get paid a $5 premium upfront. No one will call you if the stock ends below $100. In the money, you can keep the $5 and walk away smiling. If it ends exactly at $100 at the ATM, again, no one will exercise so that you will win again. But if the stock rockets to $130, your option is out of the money, and now you have to sell at $100 while it's worth $130. The break-even is $105 in this case. Strike plus premium. Selling a put option. The financial babysitter. Selling a put is like telling the market, if this stock drops below $100, I'll buy it. No one will take you up on it if it stays above $100. ITM. You keep the $5 premium. Easy money. Suppose it ends at $100. ATM. And it's the same story. You still win. If it crashes to $80, you're OTM and now stuck buying stock at $100 when it's only worth $80. You've kept the $5, but you've effectively overpaid. The break-even would be $95, strike minus premium. Master the zones, buy a call equals root for rise, loss limited to the premium. Buy a put, root for fall, loss limited to premium. Sell a call equals profit. If the stock stays flat or drops, but the loss can be massive if the stock spikes. Sell a put, more profit if the stock stays above strike, but be ready to own it if it tanks. Master the chart. Know your break-even, remember your zones, and above all, trade with strategy, not just vibes. The option chain, your menu of mayhem. The option chain is like a fast-paced digital diner menu of trades. On the left, you've got calls for the bullish folks, and on the right, puts for the bears among us. In the middle, a lineup of strike prices. Imagine you're looking at a stock that trades at $130, but there's an options chain showing a strike price of $100. This is your golden opportunity to seize the stock at a bargain. Bid, ask, and the middle school dance of negotiation. Bid what someone is willing to pay you. Think of it as the lowball offer on your rare Pokemon card, annoyingly low but real. Ask, what does the seller want? Usually it's high, occasionally outrageous. It's their dream number, like trying to sell your couch on Craigslist for full IKEA retail. Last price, what someone just paid. It's not necessarily what it's worth now, but it's a great indicator of what went down a minute ago. Volume and open interest. Who's hype? Who's holding volume? Today's party. It's the number of contracts bought or sold during the current trading day. High volume, drama, low volume, crickets and tumbleweeds, open interest. Yesterday's party guests who never left. These contracts are still open, not closed, not cashed out. It tells you how many people are still emotionally and financially invested in this particular drama. Calls versus puts, the theater of financial dreams. In this show, the main characters are calls and puts. Buy a call if you believe the stock is headed up, like a rocket with earnings fuel. Buy a put if you think it's falling, like dramatic music and market panic. Selling? Then you're either confident, cash hungry, or mildly nervous. Sell a call to collect a premium now while betting the stock doesn't soar past your strike. If it does, oops, you just sold your upside. Sell a put and get paid to buy the stock. Maybe later if it drops. If it drops a lot, you will buy it and not necessarily at a discount. Time, Theta, and the pumpkin clock. Expiration dates are no joke. Every option comes with a built-in countdown timer. Short-term options are cheaper but vanish faster than TikTok trends. Long-term options cost more but give your stock more time to behave. Wait too long and your shiny contract turns into worthless digital soup. Theta decay is real and it doesn't care about your bullish thesis. Smart moves for the sensible trader. Always use limit orders. This isn't a garage sale. Name your price. Monitor bid. Ask spreads. If the gap's too wide, you're playing guess that price blindfolded. Pay attention to volume and open interest. No one likes to trade alone in a ghost town. Trading from the options chain isn't just clicking buttons, it's performance art with money on the line. Choose your strike, pick your side, and mind the clock. This isn't eBay with adrenaline. This is Wall Street's version of karaoke. And whether you're singing bullish ballads or bearish blues, you'd better know the lyrics. The Greeks of options trading Theta, the silent thief. Theta measures how much value your option loses every day, even when the stock is not actively trading. For buyers, that's that annoying background music that won't stop playing. For sellers, it's sweet passive income. Your option is like an ice cream cone on a hot day. The longer you wait, the more it melts. Long-term options decay slower. So, if you want breathing room, give Theta less power. What does Theta chart mean? This graph illustrates how the value of an option changes over time due to the Theta effect. Remember, time is a relentless force. Time decay is coming for your money, and it doesn't take weekends off. X-axis, days until expiration. This is your countdown clock. It starts at day 0, aka, woohoo, I just bought this option. It ends on day 30, aka, why is this thing worth less than a gumball? The farther right you go, the closer you are to expiration. And the closer your option is to becoming a digital fossil. As each day passes without significant stock price movement, your option's value goes poof, like Cinderella's carriage, except with less sparkle and more regret. Y-axis, option value. This is the value of your option in dollars, or as we call it, the heartbreak axis. It starts at $5. That's what you paid proudly. It drops towards $0, which is what you might get if the stock just chills and watches Netflix for a month. Think of it like a melting ice cream cone. Sweet at the start, sticky disappointment at the end. Theta is silently chipping away at your value even when nothing else is happening. You could be doing everything right, but time still says, pay up. Your key takeaway. Theta is that sneaky roommate who eats your snacks slowly so you don't notice until it's too late. If you're buying options, remember, time is not your friend. Consider longer expiration dates to fight off Theta's slow melt, or become the option seller and collect that time decay, aka passive-aggressive revenge on Theta. Vega, Volatility's drama. Queen. Vega measures how much an option's price changes in response to volatility. It's the drama meter. In a calm market, options are like tickets to a lecture on tax policy. In a wild market, suddenly, those same options are like front row Taylor Swift tickets. What does Vega chart mean? Imagine you're shopping for insurance on a thrilling roller coaster. If the ride is smooth, the insurance is affordable. If the ride is filled with flips, loops, and surprises, the insurance will be more valuable. X-axis, implied volatility. This reflects the market's expectations for stock movement. A number like 0.1 or 0.2 means calm waters. A number like 0.8 or 1.0 signifies exciting, turbulent times. Think of it as a weather forecast for stocks. Low volatility equals great conditions, dress lightly. High volatility equals prepare for the unexpected, gear up. Y-axis, option value. This indicates the worth of your option based on market fluctuations. The more thrill and chaos, the higher the value of the option. It's akin to concert tickets. When a surprise guest is rumored, excitement drives prices up. Vega measures the potential increase in your option's value during market volatility. If you're buying options, embrace the excitement. High Vega equals great potential. Conversely, if you're selling, cherish stability. Low Vega equals fewer risks. What does delta chart mean? This chart captures the dynamic relationship between your option and stock price changes. Imagine it as your friend in drama class. Some subtle gestures unleash full Broadway performances. X-axis, stock price. This axis reflects the actual market value of the stock, ranging from $60 to $150. Picture it this way. As iPhone grows in appeal, your Apple stock rises in value. With every price movement, the responsiveness of your option shifts. Y-axis. Delta. Delta reveals your option's sensitivity, its emotional response to changes in stock price. The range spans from 0, completely indifferent, to 1, highly responsive. Delta versus stock price for a call option. On the left side of the chart, where the stock price is around $50, the delta is close to 0, meaning the call option is far out of the money. In the middle, around the $100 strike price, marked by the red dashed line, the delta is about 0.5. This is the at-the-money zone, where the option is alert, For every $1 move in the stock, the option moves by 50 cents. It's in a maybe phase. On the right side, with the stock price rising to $130 or more, the delta approaches 1. The option is now deep in the money and rises dollar for dollar with the stock. Delta indicates the level of enthusiasm for your call option, ranging from indifference to complete focus. Next time you evaluate a call option, consider its delta to gauge its energy. Delta versus stock price for a put option. If stocks were people, a put option would be that friend who only reaches out when you're down. The lower your stock price falls, the stronger that option stands by you. On the far right, when the stock is priced high, around $140, your put option is nearly worthless, out of the money, and its delta approaches 0. At this point, the option knows it's unlikely to be exercised and is essentially just there for moral support. As we approach the strike price at $100, the delta drops to around negative 0.5. This reflects a state of uncertainty. The option is at the money and indecisive. For every dollar drop in the stock price, it moves by about 50 cents. It's alert, but still contemplating its next move. On the far left, when the stock price is dropping significantly, think $50 or lower, the put option is thriving deep in the money with a delta close to negative 1. This means that for every dollar drop in the stock price, you gain about $1 in the option's price. It's a time of total enjoyment for put holders. Delta shows how emotionally invested your put option is as the stock price moves. The lower the stock goes, the more responsive your put becomes, watching the chaos unfold. Delta versus stock price for selling a call. Option: selling a call means promising to sell your stock at a certain price. If the stock doesn't reach that price, you keep the premium. If it does, you sell it cheap while everyone else cashes in. Strike price, the dashed blue line. The strike price stands boldly at $100, a pivotal crossroads in the journey of investment. As the stock price approaches $100, delta drops toward negative 0.5. In this, at the money zone, every $1 increase in stock price starts to impact you. You're earning a premium from selling the option, but stress levels rise, like facing a pop quiz from a substitute teacher. On the right side, when the stock climbs past $120, the delta plummets toward negative 1. Now, your sole call is deep out of the money, costing you for every dollar increase in stock price. It's like sharing your Netflix password only to find your friend watching the finale without you. Pretty rude. On the left side of the chart, with the stock price around $60, the delta is near 0. This means the stock is far below the $100 strike price, making it unlikely that your call option will be exercised. You're in a safe position, like assigning homework due in 5 years, low stress. Delta illustrates how the value of your option changes about the stock price. For sellers, it signals when trouble is brewing. Traders closely track the delta to know when to relax and when to prepare for challenges. Delta versus stock price for selling a put option. When you sell a put option, you're effectively saying, I'll buy this stock if its price falls below a certain level. When stock prices are low, around $60, the delta is close to +1, meaning you're fully exposed. If the stock drops $1, your position loses $1. As the price approaches, The strike price $100, delta stabilizes around 0.5. You're still at risk, but less panicked. Once the stock price climbs above $120, the delta decreases towards 0. In this scenario, the stock is doing well, your put option is in the money, and you're no longer on the hook. You're collecting premiums like free Wi-Fi, hoping the stock doesn't need your help. Delta measures your risk. Selling a put is like volunteering to catch someone if they fall, while hoping they don't. Gamma, the plot twist. Gamma is the rate of change of delta, a powerful force that captures your option's emotional response to shifts in stock prices. If delta is speed, gamma is acceleration, x-axis, stock price. Here lies the journey of your favorite stock as it navigates the market. Y-axis, gamma. This reveals the intensity of delta's reactions. The tall blue spike indicates the strike price $100, where gamma peaks and delta becomes highly reactive. Here, your option reacts sharply to stock movements. Just $1 up or down can make delta reassess dramatically. On the left and right of the chart, gamma is low, indicating stable areas. This occurs when the option is either deep in the money or far out of the money. There's nothing much for gamma to do. It's like arriving at a party that's already over or hasn't started. No tension or surprises. Gamma understands that delta has settled into its final state and won't make significant moves. When trading short-term or near the money options, gamma enhances your delta, allowing for dramatic shifts. This means your potential for profits or losses can increase rapidly. Whether you're crafting your first strategy or showcasing your knowledge, remember that options can be complex. Still, with the proper foundation, you can trade like a strategist, armed with knowledge and confidence. There you have it. Thank you for watching Min Chao's channel, where law, finance, and real estate come together for an enjoyable experience. Please like, comment, and subscribe for more tips and laughs. We look forward to seeing you in the following video.